The common advice that we receive from finance professionals and from finance gurus is that we should all stick to investing in ETFs and index funds because we don't have the skills to effectively pick out individual stocks. But what if you do want to invest in individual companies? What if you want to change up your portfolio allocation? What if you want to reap the benefits of a particular company? Maybe you just want to learn a bit more about how that company works. Or you think it might be a good investment. If any of the before statements apply to you, then you're watching the right video. In this video, I'm going to show you how I would assess individual stocks and decide whether or not to invest in them. And stick around till the end because this is not just an analysis video, we are going to put that analysis to good use. So let's go. What's up guys, welcome to Millennials with Money, the channel that helps you take control of your money and create a bright financial future. I'm Johnny, and if you like today's video, hit the like button, click subscribe and turn on notifications and tell another millennial. Now let me make some obvious disclaimers before I start the video. This is not financial advice. Please do not invest based on what you see in this video. What I'm going to show you is my approach to investing. By all means, be inspired and take elements of it to help you in your own analysis, but there is no one way to assess a company. Don't take my method as gospel, as the one correct method. And lastly, though I'm not a professional investor or trader, I am a finance analyst by profession, so I have sufficient knowledge of management reporting to be able to explain it to you in an understandable way. Now that the disclaimers are out of the way, let's get into the video. So for our stock analysis, I've decided to analyze Orange or Orange for my Francophone viewers. Orange is a telecom operator that operates in both Europe and Africa and is listed on the CAC 40 index in France. So we're going to look at Orange and we're going to look at it alongside some other telecom operators in the industry so that we can get a comparison and do some benchmarking in our analysis. Now I picked Orange and the telecom sector because, as I mentioned before, I am a financial analyst. In my previous role before what I'm doing right now, I worked in a telecoms company in France as a financial controller. And so I picked up a lot of understanding about the finance of the business, about the operating model, about the trends and the industry in general. So the way I talk about this industry in the video will give you an idea as to the levels of understanding that you need to be able to properly assess a company and whether it's a good investment or not. Now we're going to concentrate on 5 areas of analysis here. The first we're going to concentrate on is profitability. So how well can the company generate revenues and profits? The second is leverage, how much it makes use of debt to fund its everyday activities. The third is liquidity, how healthy is the cash flow situation of the business. The fourth is investor ratios, so what is the likely return on our investment. And the fifth is general business fundamentals. So we're going to look at the operating model briefly, the strategy, and the long-term prospects for the company. Obviously though, we're nearly at the end of 2020, and because we don't have a full year, what we will do is the analysis from 2010 to 2019, and we will then supplement it and pick out the key facts from the latest earnings reports from 2020. And final point before we begin is that all the information, almost all of it, that I'm going to present to you here can be found for free on the internet, whether on Yahoo Finance or whether in the company's annual reports. However, for simplicity, for time and presentation efficiency, I'm going to present the data on the Morningstar platform as it assembles all the data in one place. Whew, right, that's everything, so let's get into the video. So starting with profitability, so we look at the revenues over 10 years and we can see that they decrease and go up, but they're more or less stable. If we take the year-on-year growth over 10 years, we can see that it's just below -1%, but looking from 2014, we can see that they're producing positive growth every year. Now, 2 things here. We're looking over 10 years because it covers many stages of the economic cycle, and so we can see how the company performs in both downturns and booms. So it's a sufficient long-term indicator of the company's historical performance. And the second is, why don't we calculate the growth taking the 2019 number and dividing by 2010's number? Well, you can do that in reality, but I prefer to do growth year on year and take the average over the 10 years. And the reason for that is because You can have a positive growth between 2019 and 2010 by having 8 negative years and 1 incredible year at the end. If you have a positive average growth year on year, it means that more often than not, the company is regularly increasing its revenues on a year by year basis, which is more favorable, obviously, than the latter scenario that I presented to you. Now, although Orange has got negative revenue growth year on year, close to -1%, we can see that it's a very similar situation for a lot of the competitors, and it's even worse in the case of Dutch operator KPN. Only Deutsche Telekom has been able to consistently provide positive revenue growth year on year. From a gross margin perspective, that means the revenues minus the direct cost of revenue, we can see that Orange is a bit below its competitors or similar to Deutsche Telekom, but from a net profit perspective, they are all more or less around the same level, between 4 and 7%. So that's just a question more so of companies booking different items at different levels of their profit and loss accounts. So though it's good for a company to have a good gross margin, ultimately the net is what counts. Now that net income percentage is quite low, of course, and the reason for that is because there's a lot of high fixed costs in the telecom industry, such as infrastructure and maintenance, which makes sense when you're operating such a large telecommunications network. Another explanation for the negative revenue growth year on year and the low net income percentages for most of these operators is that the telecom industry is very competitive when it comes to price. So there's high price competition, there's a lot of promotional offers. So operators are constantly revising their prices and often lowering them. So if operators aren't able to capture new customers to cover the lost revenue through price cuts, then of course the general revenue is going to trend downwards. Now if we look at the leverage, so we're looking at 2 metrics here. We're looking at the current ratio and gearing. So current ratio is a company's ability to cover its short-term commitments and is calculated by current assets divided by current liabilities. So you can see that all of these operators, with the exception of KPN and Telefonica, can cover their short-term debts just about. Ideally, we'd want to see that ratio above 1, but as it's close more or less, then we can accept it. And in addition, the scenario that the company would have to cover those short-term debts all at once is very, very unlikely. And the gearing ratio, so this looks at how much of the company is financed by debt. So we calculate this by taking long-term debt plus short-term debt divided by long-term debt plus short-term debt plus total equity. And that will give us the percentage that is financed by debt. Obviously, the higher a company's gearing ratio, the more risky it is. But what a lot of people forget is that debt is actually cheaper to finance a company's operations than equity, because the interest that these companies would pay on their loans back to the lender is much lower than the percentage that they would pay out to their shareholders as a return on their investment. So we can see that in the telecom industry, gearing ratios are quite high, ranging from 50%, so we have Orange at the bottom of the scale, up to about 76% in the case of Telefonica. Now personally, I would be quite uncomfortable with a 76% gearing ratio because it's quite high. Ideally, I would prefer something more around the 30% mark, but this is the telecoms industry and this is how a lot of telecom operators finance their operations. Now on to liquidity. So we're looking at 3 indicators here. We're going to look at accounts receivable to sales over 3 years. We're going to look at average net cash flow change over 5 years. We're going to look at the cash balance of the company. So first, accounts receivable to sales. For those of you that don't know what accounts receivable is, this is a line on the company's balance sheet and it says how much money that the company is owed from clients who still need to pay. So ideally we want this to be low as possible. A low accounts receivable percentage of sales would mean that the company's customers are able to pay and the company is doing a good job of getting paid on time. So not much to say really for accounts receivable to sales. We can see that all of these companies are more or less around the 7-8% mark. Telefonica exceptionally is doing a better job, kind of at 5-6%. But yeah, not too much to separate the different operators here. So average net cash flow percentage change. So this is looking at the change in cash as reported divided by the previous period's cash and cash equivalents at the end of that period. So as we can see in the past, it's been a bit up and down for Orange, but from about 2016 onwards, that's been fairly stable. So that's what we like to see is kind of not huge dramatic movements on the cash flow, something that's looking stable and regular. And we can also see that in most cases, the cash flow from financing activities is negative. So that means they're not really taking on too much new debt. And if we look as well, we can see that the net cash flow is often positive. So that means that even with debt financing, they're generating enough cash to be able to cover their financing activities and keep the cash flow situation of the business positive. And if we see at the end there, we can see they've got about 6.5 billion in cash on the balance sheet. And that net cash flow percentage change that I calculated, it was about 2%, positive 2%. So looking at that 6.4 billion, then it doesn't look like that the company is going to have cash flow difficulties anytime soon. You can see that Deutsche Telekom is also having a fairly positive cash flow situation. So is Telefonica. But KPN, I'm quite worried as that is quite a low cash balance, particularly with the large negative cash outflows which are going on, which suggests that the company could be in some kind of financial difficulty. Now let's look at the investor ratios. So we've got a few here. We've got the payout ratio as a 5-year average. We've got the current price to earnings ratio, the current dividend yield, the trailing dividend yield, the average dividend growth over 5 years, and years without a dividend since the year 2000. So the payout ratio is the percentage of the company's profits that they pay out to their shareholders. And we can see here that Orange pays out about 68% of its profits as dividends to shareholders. Now, is this good or bad? It's good in the sense that profits are being paid out to shareholders in dividends. However, there is a point when this can become problematic because although you want to pay a dividend to your shareholders, you want to keep a bit to keep some cash in the business to reinvest or to use as cash reserves in a crisis situation, for example. And what we can see in some industries, not just telecoms, but with a lot of established companies across many different sectors, is that these dividend payments become regular. And because companies don't want to lose investors and want to keep paying out regularly, these payout ratios will get greatly out of control, sometimes even to the point where the company is paying out more than it earns in profit, such as we can see with KPN and Telefonica. That is an unsustainable situation and in the future could cause problems for the company. So although we want a good payout ratio, about where Orange is, about the 65% at tops, is kind of the maximum payout ratio that we want to look for the company to be able to continue doing business and generate profit, but still pay us a stable, regular return. Now, the price to earnings ratio is calculated by taking the stock price at a particular time of the company divided by its earnings per share. What it essentially helps us to do is determine whether a company is undervalued in terms of its earning or overvalued. And it's very useful to do a price to earnings analysis with several competitors side by side as it gives a more meaningful comparison. So as we can see here that Orange's price to earning ratio at the time of this video is about 10. And we have KPN at 14, Deutsche Telekom at 17, and Telefonica at about 58. So what we can draw from this is that Orange is quite undervalued in respect to its competitors. And what it means is that it may be undervalued at the moment and it might be a good time to buy at a discount. Current dividend yield and trailing dividend yield for 5 years. So when we look at the dividend yield of a company, we're talking about the return that we get on our investment in terms of the dividend that we receive. So we calculate this by dividing the dividend per share by the price per share at a given moment in time. What you'll see is that for a lot of these companies, the current dividend yield is much higher than the trailing dividend yield. That's the past dividend yield. because a lot of these stocks took a hit back in March when the crisis began. So as the price of these stocks went down in March when the crisis began, but the dividend in theory remained the same, it means that the percentage that you generate on your investment is higher. But be careful, don't let this be the only reason that you invest in a company. It's really important that you conduct a full, thorough analysis like we're doing in this video. So for Orange, KPN and Deutsche Telekom, we can see that the dividend yield is around 4 to 5%, which is a nice return. It's pretty good. We can see that Telefonica's, however, is a bit higher at about 13%. In any case, 4 to 5% return is a pretty good yield on an investment, so we can be happy with that for Orange. And looking at the annual average dividend growth, ideally we want to see the dividend for the companies growing, because it means that over time our investment will continue to generate us a growing positive return, and that yield, which we looked at before, can be a good benchmark to predict what our future return on investment might be as well. And again, we can see that Orange and Deutsche Telekom have both got growing dividends over the years, which is a really good sign. I think Telefonica kept their dividends stable over the past few years. They haven't cut it, but they haven't increased it either. And KPN, we can see there's a negative percentage there, and that's because they had a dividend cut in 1 year. So when you look at the growth over 5 years, of course, it's negative. And number of years without a dividend since 2000. Now, this might seem a weird one to have in there, but it's actually really important. Now, 20 years is a long time, and that is precisely why we're looking at this. 20 years allows us to cover a large history of the company in different stages and times of the economy. So when it's doing well, when it's doing bad. So if a company over a long period of time continues to pay out dividends without interruption, then it's a good indication that they will continue to do it in the future, even in times of crisis. As we can see, Orange has been very good at this. They've paid a dividend every single year since the year 2000. Deutsche Telekom as well. However, from 2003, they've paid without interruption, as they did not pay dividend in 2001, 2002. Telefonica have only had 1 year where they've not paid out a dividend. However, in the case of KPN, we can see that there were 4 years where they did not pay out a dividend. So that, as an investor, is a little bit concerning and may mean that in tough times, the management might feel the need to suspend that dividend. Now, I haven't talked too much about valuation here, but what I will say is if you're interested in finding out if a company is undervalued or overvalued, there are a few ways you can do this. One is by using the stock price charts on Yahoo Finance to find peaks and troughs, and you can find the undervalue and overvalue points that way. You can also use the fair value calculations and star ratings in Morningstar. So the greater the number of stars that a company has, the more undervalued it is. 5 stars representing significant undervalue and 1 star representing significant overvalue. Also a new app which has recently come out called Genuine Impact, and they present this information in an interesting new way with 3 rings rating companies based on their value, quality and momentum. Now, a quick disclaimer, I'm not sponsored by any of these 3 at the time of recording this video. However, I have participated in crowdfunding for the Genuine Impact app. So when we look at the financials of Orange, in summary, it's pretty good in terms of generating revenue on a regular basis, and in terms of profitability, it's doing a very good job to stay profitable despite challenges in terms of competitive pricing. We can see that it relies a lot on debt finance, but that seems to be something quite common in the telecom sector, and it also doesn't worry us too much because the cash flow situation is quite positive. And finally, we've seen that we can expect a nice return on our investment and with minimal interruption, hopefully to dividends going forward, as has been the case in the past. Now, a lot of what I've said here for Orange also applies to Deutsche Telekom. So in this next section where we look at the 2020 news and the business models, I'm going to bring Deutsche Telekom into this section as well, and we're going to look at both companies. So in terms of how both of these operators have done in 2020, both have done pretty well. their mobile and broadband businesses and fixed lines have been relatively uninterrupted by that which must not be named. However, there is two areas that have been impacted. One is delayed projects, so that will obviously delay revenues that were expected sooner for the company. And second is the roaming business. Now, roaming has obviously been abolished within the EU, but obviously travelers coming from outside the EU will be subject to roaming charges when they arrive and they use the mobile networks here. Roaming generates significant revenues and big margins for mobile operators, and with there being travel restrictions and less people traveling as a result of the current situation, of course, roaming revenues have been reduced and these operators have not been able to generate these big margins as they did before. Nevertheless, both Orange and Deutsche Telekom have been able to increase their revenue based on the same period last year, with Orange being able to increase their mobile and broadband subscriber base, Deutsche Telekom as well, and they've also had the additional added advantage that they have integrated Sprint in the US into their operating model, so they're now generating additional revenues from that acquisition. Finally, let's look at the business fundamentals of both of these companies. I'm just going to give it in a nice quick summary what the key points are to take away for both companies. So Orange is obviously a very prominent large-scale operator and as such is able to achieve cost savings through its scale. It has the highest quality network in France, but not only that, it has its own low-cost offer under the Sosh brand, and this has been primarily to compete with another operator in the market called Free, which offers a lot of plans at a very low price. Outside of France, they have big operations in both Spain and in Poland, and also in Africa, in Tunisia and the Ivory Coast, where they are continuing to expand their influence and networks in these countries. So that is one of their key projects looking towards the future, the expansion of those networks. They're also in the process of rolling out 5G, and they're making a move to go digital and put artificial intelligence at the center of their operating model, which could generate them some cost savings going forward. Now, Deutsche Telekom is also a very large scale operator. They have significant operations in both Germany and the US. And in the US, they have some very competitive pricing and they're ranked among the top operators in the US. So they're able to compete both on price and the quality of their network. Looking towards the future, they're also working on 5G development, but one of their key activities is IoT projects. So the IoT is the Internet of Things, and it's all about connectivity in everyday life. For example, their IoT solutions are being implemented in agriculture settings, in logistics and supply chains. They've also launched a solution which counts the number of customers in a retail store at any one time, which will trigger a traffic light system to stop people coming in order to maintain social distancing given the current context. So when you look at a company from a business model perspective, you need to look at something that has a good past history, that is in a good position today and has positive prospects for the future. And I think, as I've just explained, that we can see that that is the case for both Orange and Deutsche Telekom, large companies with good track records and good potential for the future. So you made it to this point in the video. So with the analysis that we have just carried out, I'm going to invest in both Orange and Deutsche Telekom. But not only that, I'm going to put them in a trading 212 pie, and I'm going to make this pie public so that we can have regular updates and see how these companies are performing. And of course, I'm not going to have just two companies. I am going to study more companies and add more companies to the pie. So what I would appreciate, guys, is not only that you give it a thumbs up, but leave a comment to let me know if this video was useful, if it was too detailed, if you'd like to see something more high level. Also, even though I have an idea of which industries I will look at, if there's any that you'd like me to take a look at to consider adding companies to the pie, then please leave them in the comments as well. I'm still consulting with myself to decide how I'm actually going to run the pie. I'll probably invest on a weekly basis, but what I have decided is that I will be investing only in European companies, because I think there are a lot of good companies in Europe that are not covered by English-speaking finance YouTubers, and I would like to try and fill this gap in the market and also give you some alternative investment ideas, because I think honestly there are some good companies in Europe that can give you a good return on your investment. And just before I wrap the video up, if you've not heard of Trading 212, it is a commission-free platform for investing. And if you sign up via the link that is in the video description, you can get a free share worth up to £100 or €100 when you deposit only £1 or €1 on the platform. So definitely check that out, guys. That's all for today's video. Hope you enjoyed it. Be sure to check out the Millennials with Money social media and internet pages, and also check out the other videos on my channel. I'll see you on the next video, and let's get this money.